Every business, whether it's a tiny coffee shop on the corner or some huge global corporation, is playing a game. And like any game, it has rules. And these aren't just, suggestions. They're the core concepts that make sure everyone's playing fairly and, maybe more importantly, speaking the exact same language. So let's pull back the curtain and demystify the rules of the business game.
All right, here's our game plan. We're going to start with the one single rule that all trust is built on. Then we'll get into the core assumptions, the things you just have to accept before you can even play. After that, we'll dive into the nitty-gritty, the mechanics of how you actually keep score. Then we'll look at the guiding principles, kind of like the spirit of the game. And finally, we'll wrap it all up by seeing why these rules are, quite literally, the bedrock of the entire financial world. So let's begin at the beginning, with the absolute foundation. Before you can record a single dollar, you have to grasp this one simple, powerful idea. It's the concept that separates total financial chaos from order.
And here it is, the business entity concept. All this means is that a business is its own person, legally and financially separate from its owner. Every single thing is recorded from the business's perspective. So if the owner puts their own money into the business doesn't see it as the owner's money anymore. It sees it as capital. It now belongs to the business. Think of it like this. Your new coffee shop is not your personal piggy bank. It just isn't. The cash in the register, that belongs to the shop. The money in your own wallet, that's yours. There are two completely separate things. And believe me, this separation is absolutely crucial. It's the first real step to creating clear, trustworthy financial records. Okay, so we've established that the business is its own thing. Now let's look at the core assumptions. You can think of these as the setup rules you have to agree on before the game can even begin.
First up, the money measurement concept. This one's simple. Accounting speaks one language and one language only, and that's money. If you can't put a price tag on something, whether it's in dollars, euros, yen, whatever, it doesn't go in the official books. And this is a perfect example, right? You can, and you absolutely should, record the $10,000 you spent on that shiny new espresso machine. That's a clear monetary transaction. But your star barista's incredible can-do attitude, as valuable as that is, and it's probably immensely valuable, you just can't assign it a price, so it stays off the financial statements. Next, we have the going concern concept. This is basically a rule of optimism. We just assume that the business is going to be around for a long, long time, not shutting its doors tomorrow. And this simple assumption totally changes how we value stuff. You can see the impact of that right here. Because we assume the coffee shop is a going concern. We value its building based on what we paid for it, its historical cost, not some desperate fire sale price we'd get if we had to liquidate everything tomorrow. The assets are valued for their ongoing use, not for a quick sell-off. But wait, if a business is going to be around forever, how do you ever actually measure its success? Well, that's where the accounting period concept comes in. We take the indefinite life of the business and we chop it up into standard, consistent chunks, like a month, or a quarter, or most often a year. This lets us regularly hit pause, take a financial snapshot, and see how we're doing. And finally, in this section, we have the cost concept. This one's really straightforward. We record assets at their historical cost, what we actually paid for them back in the day. So that piece of land you bought 10 years ago, it might be worth twice as much today, but on the books, it stays at its original price. Why? Because that price is objective. It's a fact. It's verifiable. Okay, so we've got our foundation, we've got our assumptions. Now, how do we actually play the game? This section is all about the core mechanics, the nuts and bolts of how every single transaction gets recorded. Pay attention, because this is the big one. The dual aspect concept is the engine that drives all of modern accounting. It says that for every action, there is an equal and opposite reaction. Every transaction hits at least two accounts. You can't just get something for nothing. There's always a balance. Let's see it in action. Say your coffee shop buys a new grinder. So what happens? Well, you gain one thing, right? An asset, which we'll call equipment, goes up. But you also have to give something up to get it. In this case, another asset, cash, goes down. One side goes up, the other side goes down. The scale stays perfectly balanced. And that perfect balance? It's all represented by this fundamental accounting equation. Assets equal liabilities plus capital. It just means everything the business owns has to equal the claims against what it owns.
This equation must always be in balance. After every single transaction, it is the golden rule.
Now let's clear up two ideas that can get a little confusing: accrual and realization. The accrual concept is the main idea. We record things when they happen, not when the cash actually moves. Your March electricity bill? That's a March expense, even if you don't pay it till April. Now the realization concept is just a specific part of that, but it's all about revenue. It says you record revenue when you've earned it, when you deliver the service, not just when you get paid.
So if we're recording revenues and expenses all over the place, how do we get a true picture of our profit? Well, that's where the matching concept comes to the rescue. To figure out the profit for, say, March, you have to take all the revenues from March and then match them with the specific expenses that you had to pay in March to earn that revenue. You're comparing apples to apples. All right, we've covered the setup and the mechanics, but accounting isn't just some robotic process. There's a spirit of the game, a set of guiding principles that demand good judgment, a sense of fairness, and even a little bit of wisdom. This quote, it perfectly captures what's called the prudence concept, or sometimes conservatism. It's really a principle of cautious wisdom. It means that when you're faced with uncertainty, you always err on the side of caution. So you don't count your profits until they're basically guaranteed, but you do account for potential losses as soon as they seem possible. It's what keeps financial statements grounded in reality. And here are 3 other essential principles, real quick. Consistency just means you use the same accounting methods every year. You can't just switch things up to make your numbers look better. Materiality says to focus on what actually matters. A $10 mistake in a billion-dollar company? Who cares? It's not material. And full disclosure is all about transparency. If there's something important an investor needs to know, you have to tell them. No secrets. And when you put all of these guiding principles together, they all build toward one single, incredibly important word: trust. Without them, how could you ever trust that a company's numbers were fair, or that you could compare them to last year's, or that they were telling you the whole story? The simple answer is you couldn't. Okay, let's bring it all home. We've walked through a whole bunch of different concepts, from these big foundational ideas to the tiny mechanical details. So why? Why does this whole complicated framework of rules matter so much in the real world? It's because all of these individual rules, they come together to create one single universal system, a common language for all of business. This system is what makes sure financial reports are uniform, reliable, and comparable, no matter if that company is in Tokyo or Berlin or Kansas City. It's what lets an investor in one country feel confident putting their money into a business on the complete other side of the planet. It's what makes global commerce work. In the end, these concepts are so much more than just rules for accountants. They are the scaffolding that builds a world of financial clarity and trust. They allow investors, managers, and all of us to make smart, informed decisions. They take the messy, complicated reality of business and turn it into a clear, understandable story. Which, of course, leaves us with one last big question. What happens when someone decides to break the rules?